Thank you, Mr. Basu, for your insights. And now invite Mr. Sanath Kumar, CMD, National Insurance, our conference co-chairman, to kindly address us.
Sanath Kumar, President, Indian Chamber of Commerce, co-chairman of the conference, Mr. Basu, conference chairman, Mr. Basu, chief guest of the day, Mrs. SHri, member IRD, and my eminent colleagues on the dais, members of the media, and delegates to this 9th edition of Insurance Summit by the Indian Chamber of Commerce. National Insurance Committee is extremely proud to be the conference sponsor because over the years, the quality of the contents, the deliberations, the vastness of the topics has made this event of Insurance Indian Chamber of Commerce Insurance Summit a seminal event in the insurance, and I would even say the financial ecosystem of this country. It's indeed an honor to participate in this, and I thank the organizers for inviting me to speak on this occasion. In the limited time available to me, I will flag out all these points. One obviously would be the thing which the team runs on, reaching out to exponential growth and international mapping new growth contours. The often and quite often discussed point is the low penetration ratio. I've been articulating this point in personal perspective in many of the forums that I've been associated with this. Journalist industry, they say your penetration is only about 0.80%. But look at Korea, look at Taiwan, look at Indonesia, look at Brazil, look at other emerging nations, not to speak of the developed ones. There are 2, 3, 2.5. So there's something wrong with you. You are only at 0.80%. The industry has been really thinking about it and various things. See, the Indian journalism industry has been the consistently fastest growing journalism industry among all emerging economies for the past 10-15 years. The industry has been growing at 12%, 13%, even touched 20% and came down to 11-12%. That is the growth rate. And Indian economy has also been growing at 7.8, whatever statistics that you see, it's been at that rate. Despite this, when we were doing 25,000 crores, the penetration was around 0.60%. The industry was doing 50,000 crores, the penetration was around 0.6077%. In 2015-16, the industry touched 96,000 crores. We did about 0.80%. Next year, 16-17, we might do 1 crore 20 lakhs. Again, it will be only 0.81%. In 2017-18, if you touch 1.5 crores, so incidentally, if you plot it, it will again be 0.85% of the GDP. So the growth at 12%, 14%, 15%, we understand is not going to significantly increase the penetration. Now here we have a problem. Then what is the problem? Is the problem with the denominator in that ratio, which is the total premium divided by the GDP. Do we have a problem there, or is it a jinx there? 0.1. Second is the density, which Mr. Sutsan was talking about. Insurance density also may not shoot up to very large levels. The studies of the developed world have seen, unless you touch the annual per capita income of $3,000, it's now $1,500, really the penetration doesn't grow. I mean, that is some of the studies have shown that. So do we wait till we touch that $3,000? Is the problem the economy, or is the problem the insurance industry, or both? You have I will leave the eminent delegates to long ponder about that and discuss it later. So this is the point. Now, I would like to come to another indicator. Here also he pointed out. By some, there is no definite data available, but by some point of time, we believe that non-life industry has touched. There are about 400 million people who have taken some kind of a non-life insurance policy out. 440 crore people. Now, this is quite large, simply because very few countries have that kind of a population. But that is never mentioned anywhere when you discuss the performance of the general industry. If you add motor car insurance, if you add RSBY, if you add the Prime Minister's SHri, it will add up to something around 40 crores. Now the point is, how many of those 40 crores insurance holders have taken that policy voluntarily and by choice? Now then you have another issue facing you. How many of them indeed know that there is a policy and I can claim from that. So here, let me just present before you, the eminent audience, you have a problem where you are growing 12.15%, and you will not grow definitely 25-30%. You are growing at 15-16% continuously for the past 10 years, but you are never able to increase even up to 1.5% of the penetration. And it will be continued to be that for another 3-4 years, even if the industry goes at 15-16% or 20%. You see the figures, it will work out like that. So is that the growth? One of the problems is that the point which you have been pointing out, the GDP in India, about 60-65% of the GDP is service sector, which Korea and Taiwan or Indonesia have a different thing. Most of it is manufacturing sector. So here, our growth is retail consumption driven growth and not investment driven growth. I mean, the insurance premium growth is retail consumption driven growth, consuming of motor car, so you take an insurance. Your health insurance, because you are employed, you take a health insurance, or you voluntarily also you take a health insurance. Consumption driven retail health growth cannot be growth rate in fire or health or property or engineering, because either the growth rate in this area is quite low, or even that growth is not able to record in insurance premium because heavy competition, the premium keeps on coming down. So this could be one of the reasons that why, though the economy is growing, the industry is growing, the penetration continues to be low. Second thing is, the growth may be inflation. Is the industry adding more number of policy holders, or the industry showing some more premium, the sum insured goes up, the motor vehicle value goes up, the health cost goes up, and is it because of that inflation-driven premium growth, or is there an organic premium growth? Are more and more people taking insurance every year, or the same people who have insurances pay more premium or take more products by themselves? Now you have another point here. These are all the things which I think somebody should really deeply look into the figures and come up with an idea why, despite consistent growth of 12 to 5, which is decent, I would say that 12 to 15% is bad. 15% growth rate, you are still going around 0.60 to 0.80 or 0.90% of the penetration. That is one. Second point I'd like to flag is the profitability. Again, that is an issue that as on 31/12/2015, the published figures show all the non-life insurance companies have a combined ratio above 110%. All the general insurance companies in the country has, including non-standalone health insurance claims where the health incurred loss ratio is around 50 to 60%. They too have combined ratio of 110%, which is again a kind of a thing which is plaguing the industry. And there is, frankly to me, it's a practitioner of general insurance, this doesn't seem to be much light at the end of the tunnel. Because your health insurance business is daily. Your motor insurance, despite handsome enhancements by the third party, premium by the regulator, still it is, you're not able to make both ends meet. Because either the distribution cost is going up, or the incurred loss ratio is going up, or the management cost is going up, whatever it is. The reason is that it is still the combined ratio. So we have started articulating to the credit rating agencies. So here, do not compare us with the international market where the combined ratio is traditionally less than 100%. You look at it 105 as an optimal number, because here you have a huge technical reserve motor third party liability claim, which is not a function of the insurance industry, it's a function of the judiciary. Because typically a claim takes about 5 years to mature, and we need to keep that in our books of accounts and add interest of 7.5% to 8% every year. So it is a thing which I have no control over that. If I expose into motor insurance, I do get it. And so look at 105, 106% as a good combined ratio in the industry. They listen, but ultimately when the credit rating comes, they go into the computerized credit rating methods, which doesn't take account of this Indian phenomenon. So here you have, and the price war, which is an offshoot of the competition, continues. Today I am very surprised to see the percentage, the property insurance like fire and property, where investment would take place, where the asset value can go up. The discounts range between 80 to 75, 80, 85% discounts. This is the kind of discount that market is having. And we are giving those discounts to industries who can afford to make payment of premium. It's interesting that discount will not go to the retail consumers. Here the retail discount goes to those corporates who can technically afford to pay the premium. They bargain and they get the best discount because of intense competition in the market, which should continue. Though there are a lot of attempts, and I'm compliment GIC for stepping into it to find out some kind of reasonable prices for some of these segments of the population. There is a lot of activity going on. And a lot of activity between the insurers also to see that prices do not go up and we increase the premium, because we can no longer afford to show premium. One of the reasons for this slackness of not reaching the 100% combined ratio is the comfort that the industry is providing by giving a decent 9% yield on your investment. All these insurance companies have investments and the yield is about 8 to 9%, and that would assure them that your balance sheet will be on the green side at the end of the day. Is that great complacency in your hunger to drive for less than 100%? I believe it is so. Then I would also feel that the proposed listing today, insurance industry has not been analyzed and aggressively analyzed by the market. It's not been in the market. There's a lot of activities that we just talked about the listing and entering the market. The moment you enter the market, I believe that the market analysts and the market watchers and the sharp investors would go for the combined ratio and not for the net profit in showing the balance sheet. When they start doing that, there would be pressure inward in the market and the prices would go up and there would be profitability coming exactly the way it happened in the developing world. When the interest rate was high there, companies did not make underwriting profit. When the interest rates came down to 1 to 2 negative, insurance companies started making underwriting profit out of sheer pressure. This would happen. I don't want interest rate to come down to 1%, obviously, for selfish reasons. But the market analysts, I'm sure, would drive the companies to have more discipline in pricing, to pressure towards making underwriting profit. And I think that is the only one. I would like to see a year back when the regulator came out with what is called this pricing formula, which is supposed to have created some kind of underwriting discipline. It did not happen. That means self-discipline will not work in this market. But intense criticism and intense price on your pressure shares, when you see your shares moving up and down on the exchanges, driven by the market analysts, the sharp information about it, would make the insurance companies behave. So that is a profitability. So I would personally look towards to this listing and entry of the market, which would drive the profitability of the industry. This is one perspective which I carry personally. Third point, sir, I will take a few minutes here, is reaching out, which is another theme of this conference. You see, there was a major hurricane in Andhra Pradesh called Hudhud. There was a huge flood in Chennai. There was a disastrous flood in J&K, and you know what happened in Uttarakhand. These are the 4 major catastrophes that happened in India in the recent past. Very curiously, this did not drive a demand or surge for procurement of flood cover of equipment. We thought people would start queuing up in our front of our office the next day morning in Chennai, asking for, can I have a flood insurance? None turned. Why did not people turn? I believe, again, now we had an interesting, the regulator is doing a major program in Tripura, which is one of the highest literacy levels in the states. They are trying to go for 100% financial inclusion drive in state of Tripura in collaboration with the Tripura state government. We are also partly involved. There was a recent review, and after that we are looking into it. We are going to corners to all the villages in Tripura, talking to people about insurance awareness and all. The recent review, we understood that one of the major points that people are not going for insurance volatility is that they do not have any credibility in the system that you would pay the claim at the right point of time, the right amount of claim, and keep it. There is a credibility gap. You promise, you take a policy, there are a lot of products, a lot of offerings, but when it time to come to the moment of truth or the payment of the claim, there is a general kind of feeling that insurance companies may not. They might try to get out of the claim by quoting some offerings, or even they pay the claim, they pay not the full amount, and even if they do pay the full amount, it will be delayed. So this is so we try to input the regulators and the state governments trying to push through the idea that to tell them it's easier to make claim. It's easier to get claims, provided you know the documents to and understand the documents to submit. You will be transparent with insurance companies and the claims will be paid for. This would be a critical factor in increasing the credibility in asking the people to come forward to take insurances, especially aftermath of a major flood like Chennai. Other major problem which here is the government as an insurance provider. People look towards the government for compensation, look for waiving of economic loans, for waiving of creating building for them. The Chennai government constructed a lot of houses for the Chennai affected people. That should have been done by the risk carriers of this country. The compensation should have come from the risk carriers of the country and not from the government. The moment that shift, people look towards the government for waiver of the farm loans or whatever it is. All of the farm loans should have been protected by the risk carrier. How do we move from the people looking towards the government for support and solace and replace that with a risk carrier framework in this country? Now that is to be thought about the policy holders and the informed delegates who are sitting in front of me. So this is the people, because anybody who is working in microinsurance, which I have worked, you go to a village and try to sell microinsurance, they think that should be given by the government on a free or a subsidized manner. People have not really come out that I would be buying a protection for myself, I'm paying my premium and then giving it. The schemes like RSPY, scheme like Prime Minister Suraksha Bima, scheme like Fasal Bima Yojana, where the premium is heavily subsidized, and many other government schemes have created an atmosphere in the country. The government should be the first supporter for risk mitigation, and second only the insurance company comes. Now we need to work on this. Risk carriers in this country should be the first, and government should be the second support at the time of discuss. Now probably I am thinking too far, but this is a real issue that we face when we move into the microinsurance level market. I will not carry further. There are many speakers before me. I just flag these 3 points to you, and I once more thank the organizers of this meet, 9th edition of this insurance summit, for giving us a participation here. Thank you very much.